Okay, let's start. So in our last class, we started discussing about the guidance for the standards. Okay, so we first of all had a reading whereby we introduced ethics and trust in the investment profession. When we were done with that reading, we moved over to the codes and standards. So we also finished that reading where we talked about the CFA Code of Ethics and then the 7 professional conduct standards. So we also started the third reading, which is the guidance for the standards. So under the guidance, we are actually done with the knowledge of the law. So this was actually what we did in the first class. So we said when we resume today, we are going to try to treat the other standards. So there are some other standards that are still remaining that we need to touch. So we are just done with the knowledge of the law. We are going to enter the next one, independence and objectivity. So we are going to continue. I hope we are together. I hope everyone can hear me. I hope you can also see my slides.
Yeah, sure.
Okay, good. All right. So like we do, if you have any question, any comment or anything, you can always just let me know, and we can answer the question together. Okay, so the next standard, which we call the standard 1B, is independence and objectivity. So let's read what the standard says. So the standard says that members and candidates must use reasonable care and judgment to achieve and maintain independence and objectivity in their professional activities. Okay, so members and candidates must not offer, they must not solicit, they must not accept any gift, benefit, compensation, or consideration that could reasonably be expected to compromise their own independence or another person's independence and objectivity. So what the standard is saying is this: you are not to offer somebody any gift, any benefit or compensation. You are not even to accept, you are not also to solicit any of those things that can compromise your own independence and objectivity. And don't also give somebody else, gift, compensation, and all those other things that can also compromise their own independence and objectivity. So let's look at some of the things that we need to do in order to, work consistently with this standard. Remember, so what we are doing is this: we are looking at all the whole principles, but like I told us earlier on, in the actual exam, the questions will be like case study based questions. So they will tell you about a particular charter holder, a particular candidate. They will give you their situation, like tell you where they work or what they just did. And your job is that based on the fact you understand the principles, you should be able to tell whether this person violated the code and standard or whether they didn't violate. So that is actually your job as we proceed. Okay, so let's see some of the things. So the key about this standard hits this state home that you should, as a CFA charter holder or as a member, you should maintain your independence and objectivity in your professional work. That is what the standard is letting us to know. Okay, so any situation at all that can cause you or perceive to cause you to lose your independence and objectivity, this standard says that you should avoid those kind of situations. Okay, you should avoid them. So there are various external sources that would come to or try to influence your what do they call it, your independence and objectivity. Okay, so let me give an example. So let's say even where your company you are working, your bosses at the office might try to influence your independence and objectivity. The issuers, maybe people that you are trying to underwrite securities for, they might try to influence your independence and objectivity. The brokers, the dealers you are working with, the rating agencies or whatever, all those people might try to influence your independence and objectivity. But this standard says that you should make sure that you don't allow yourself to be influenced such that you lose your independence and objectivity. So some of them can give you things like gifts, entertainment, tickets, favors, job referrals, or even shares in oversubscribed IPOs. So these are the different kinds of gifts that they can give you. And some of these gifts can actually influence your independence and objectivity. I remember telling us a story in the last class. Someone was telling us a story where a company they went to go and audit, the kind of special treatments they gave them in that kind of company. And you will know that this kind of special treatment, it's something that after taking, the chances of you writing, you just watch what you are writing for that company after the kind of social treatment. So that's actually what it is. In the curriculum, you see examples whereby imagine you want to go and visit a company where you want to research their security, and the company is offering to send a private jet to come and pick you up, offering to, put you in one 5-star hotel, offering to do this for you, do that for you, even give you some shares in their company and all those kind of things. After collecting those kind of security, automatically, you already know that your independence and objectivity has been influenced, because if you found out that that company is not really worth much, it might be difficult for you to actually value it appropriately. Okay, so because of that, any acceptance of benefits that can threaten your independence and objectivity, according to this standard, is prohibited. So they actually went ahead to say that you can actually collect modest gifts and entertainment, right? So something like you went to go and research a company and they gave you, let's say, a pen, a company corporate pen, and a company notebook to take some notes. Those things are not anything. Or maybe they gave you a cup of coffee, or they gave you bottled water. Small things are really don't really mean much, right? So some of those things, you can see that those things cannot influence your independence and objectivity. But if they now start talking about things, let's lodge you in a 5-star hotel, give you some of our shares, some of those kind of tickets. Let's give you a ticket to come and watch Chelsea match, Man U match, and all those kind of things. You already know that after taking those kind of gifts, there is high chances that your independence and objectivity is influenced. I hope we're together.
Yeah.
All right, good. Let's continue. Okay, so let's talk about client relationships. Client relationships. Okay, so according to this standard, gifts from clients were distinguished from gifts for other entities. So the gifts coming from clients were actually, distinguished from gifts coming from other entities. So we normally assume that any gifts that comes from your clients, directly from your clients, we normally assume that those gifts are supplementary gifts, right? So those gifts don't really have that chances of influencing your independence and objectivity. After all, we have said that we manage the portfolio for the benefit of the client. So probably if you do so well for a client, and a client decides to compensate you for managing their portfolio very well or whatever, then that kind of gift really, it's not meant to influence your independence and objectivity. But the problem is this. So the curriculum noted that even if you are collecting gifts from your clients, you need to report and disclose that gift to your employers before accepting that gift. But if you couldn't disclose to your employer before accepting that gift, after accepting that gift, you are to notify your employer. So the reason for this is this, right? Sometimes if a particular client keeps on giving you gifts while the other clients are not giving you gifts, there is chances that you might start to favor the client that gives gifts at the expense of the clients that doesn't give, right? So if, let's say, I did so well for this client and they gave me gifts, and I did well again for them, they gave me gifts, there is high chances that if things like oversubscribed IPO comes, I might want to allocate more for them so that I can still do well, so I can keep on earning some of those gifts from them. So that is why the CFA Institute requires that if clients give you gifts, it's fine, but you have to report that gift to your employer before or after accepting if you couldn't disclose. I hope you can hear me.
Yes, I can.
Okay, good. Now let's talk about the firm pressures. Firm pressures. So your firm, where you work, You can also be influenced where you work, okay? So a situation whereby your boss or your supervisor in the office or whoever is above you in the office might actually want you to, issue a bias research or issue a bias report. Okay, so that can actually happen. And, since they are the ones that pay you, if they start mounting pressure on you to issue a bias report, there is chances that you might actually bow down to that pressure just that you can keep your job. So this standard says that if you're a CFA member or you're a charter holder, a candidate, you should actually resist any pressure from your firm to issue a bias report. So this standard says that whichever report that you issue, you must make sure that that report conveys your true opinion. So make sure that that report is free of bias from both internal and external pressure. So internal is people, maybe your senior colleagues in the office. External might not be from any other, external company that you are working with. So make sure you don't, bow down to any of those their pressure. So give only true opinions that are free from bias, and also make sure that whatever you are giving is stated in clear and unambiguous language. If you are also a sales or a marketing professional, you have to also make sure that you ensure objectivity in promoting investments for clients. So this is actually what the standards requires you to do. So the summary of the whole thing is this. So make sure you protect your independence and objectivity. So if you're answering a question like this, so let's say a particular analyst after doing a research on a particular company, he found out, so he submitted the research to the CEO or whoever, and after looking at the report, the supervisor says that that particular company you are recommending sell, we are actually looking for their business. And in order to secure that business, we recommend that you change whatever you have in the research. Okay. So if the analyst agrees and goes ahead to change it, then he will be in violation of this standard. Okay. So you don't allow your colleague, your supervisor, your employer, or whoever to influence your research report. Okay. Then again, in the curriculum, we have the buy-side clients. Okay. So sometimes the portfolio managers, which are the buy-side clients, they may actually pressure the sell-side analyst. So the sell-side analysts are the research analysts, okay? So sometimes they may have pressure from the buy-side analyst to issue a favorable rating to protect their portfolio performance and also their reputation, right? Yes, that can also happen. And according to this standard, the standard says that you are not to bow to any pressure from any party, whether it be internal or external. So if the analyst or the sell side analyst in this question goes and bows to that pressure and issues that kind of research, then he will be in violation of this standard. So this buy side clients normally do this sometimes because they are trying to, protect their professional reputation. Okay. So they might want to, support the sell side rating inflation. I hope we're still together. Is there any question so far on what we have discussed?
None from me at the moment.
Okay. Okay. So if you have any question at any point, you are free to ask. Did any of us go to solve those questions I recommended at the last class? Did anyone attempt?
I actually didn't finish the last class because I had network issue at the point. So probably I missed
Oh,
that part. And I'm here to get the video. We are here to get the video. So yeah, sorry.
okay. Okay. I actually recommended that we attempt the last class because, like I said earlier on, one of the secrets to pass this CFA exam is not just about attending lectures, right? Yes, it helps to attend lectures, really, seriously, it helps. Because once you attend lecture, people actually can even just take from what they attend, what they have in the lectures and go and write the exam and pass. But for me, that's not the main thing, right? Because after attending the lectures now, your job is now to sit down and go and review what you learned And I stressed something for us in the last class, which I told us that apart from, lecturing candidates in the CFA exam, I also train people on how to read and learn effectively. And one of the things that we know is that after learning a thing, if you don't go and review that thing, something they call forgetting curve, you tend to forget that thing over a while. That's why you notice that there are some courses that you attended the lectures when they were teaching, you really understood them, but maybe after 1 week or 2 weeks, you now went back to try to solve questions on some of those courses. You notice that some of those things you can't even really remember again. Some of the formulas you have forgotten, some of the steps and the processes you have forgotten. So if you want to combat that, you always try to reduce the distance from when you learn any particular thing till when you practice to actually help that thing to stick faster in the long run. Okay. So I'll still encourage all of us to go and solve those questions because of how
Yeah.
important your ethics is.
Okay.
Okay.
Yeah. So we. So yeah, can you? Which of those questions are you referring to? Is it the one in the curriculum?
Yes, the one in the
Okay.
curriculum.
Yeah, that's fine. Thank you.
The one in the curriculum. So they have some of them inside the blue boxes in the curriculum. If you are reading, you'll be seeing some in the blue box. Then they have some at the end of chapter. They have
Yeah. I'm familiar with those. Yeah.
So try and do all of them. Try and do all of them. Like as much as possible or as many times as you can, do all of them. It really helps a lot. And you notice that the more you do them, the more the concepts become clearer. And someone said something. It said, so if you go on the exam day, ask, what are you going to be doing on the exam day? And the answer is that you're going to be solving questions on the exam day. So the question now becomes, why do many students waste so much time reading than solving questions? I don't know whether I understand what I said now.
Yeah, I do. I agree with you.
Yes, in the exam day, the main thing you are doing is solving questions. So now, why do many students now waste time reading than solving questions? So there should be a balance. You should read, obviously, so that you have the input, so that you can now go and keep out via solving question, which is the output. But if you waste so much time reading, and you are not doing the question part, when you now enter exam hall and they give you questions, solving questions now looks strange to you. Okay, solving questions now look strange to you. But if you actually do enough questions, there is a way that you solve questions that on the exam period or when you enter exam hall, you won't even be fidgeting when you see questions because now you're already used to solving questions. Okay. Yeah, so I will encourage us to do that. Okay, so we have fund managers and custodial relationships. Okay, so members and candidates must avoid accepting gifts or compensations that may influence decisions related to hiring outside managers or custodians. So any gift at all. So if you're a hiring manager, right, you hire some managers to manage certain portfolio. Make sure you don't accept any gift or compensation that can influence your decision. So some of those hiring managers might want to give you certain kind of things. And obviously, you know that what they are giving you is to, what do they call it? What they are giving you is actually to influence your decision, because once you accept their gifts, there's chances that you might want to actually hire them in the pool of what you are considering. Also, sometimes some of the outside managers, some of them might invite you as a member or a candidate. They might actually invite you to attend their educational or marketing events. Okay? Yes, they might actually invite you to attend their educational or marketing events. So the standard says that if you are invited, you have to review that invitation. Okay, you have to review that invitation to decide whether you can actually attend to those events and yet maintain your independence. So if you find out that attending that event might influence your independence and objectivity somehow, then no need to attend. But if you find out that you can still attend that event and maintain your independence, then according to the standard, you can actually attend. Then we have a part on investment banking relationships. Investment banking relationships. Okay. So sometimes the sell-side firms pressure analysts for favorable research reports. So remember, the sell side are the ones that do the research and issue it to their clients. So sometimes the organs in the sell side firm actually pressure the research analyst that works for them to issue favorable research report on their investment banking clients. So if they have some clients that they have investment banking relationships with, they might actually pressure their analysts to make sure that they issue a favorable report for those kind of investment banking clients so that they can still maintain their business relationships with those clients. Okay. So according to this standard, if you're a member, you must actually, encourage your firm or adopt and follow best practices in maintaining your independence and objectivity. So it's a joint thing. So since this pressure normally comes, the standard recommends that both the members and candidate and their firm, they should come together and adopt and follow best practices to maintain their independence and objectivity, and also protect their analysts from undue pressure coming from these investment banking colleagues. So the recommendation is that we can use enhanced firewall protection. Okay. So the enhanced firewall protection can come in double fold. So it can be that we are going to separate the reporting structures for personnel on the research side and the personnel on the investment banking side. So let's separate the reporting structures of those two sides so that we can reduce the pressure the research side is facing from the investment banking side. Another one is that we should also make the compensation arrangements to minimize the pressure on the research side and reward objectivity and accuracy. So the research analyst, let's pay them or make their compensation in such a way that they are rewarded for objectivity and accuracy. Okay, so these are like enhanced firewall procedures or policies that the organization can enact to protect their sell side analyst or the research analyst. Okay, so make sure you note about this. Then what about performance measurement and attribution? So you know that if you are seeking for clients as prospects, or you have some clients already, over time you need to measure the returns of their investments and report it to them, right? Also, you can also measure and keep those returns. Just when you want to do marketing, you can have something that you are pushing to your prospective clients. Okay, so according to this standard, whenever you are trying to do your performance measurement and attribution, make sure that you be independent and objectivity, and don't allow any person in your firm to influence whatever research reports that you are going to issue. Okay. Then in terms of public companies, so we know that analysts normally do research public companies. So like we have First Bank, we have Access Bank, we have all these Cornerstone, Nesto, and Co. Okay, so analysts normally research these companies, and you know that after researching, you can issue a sell recommendation or a buy recommendation, or probably a hold recommendation for any of those security. So because of the impact of issuing those reports, you will notice that these companies tend to come and pressure the analysts or the people doing the research so that they can issue favorable reports for them. Because let's say, for example, if you issue a sell report to a company, people will start selling the securities of that company, which will affect their share price, right? If you also issue a buy recommendation for that company, people will keep on buying the shares, which can also increase their share price. So because of that, they tend to pressure these analysts to issue favorable reports for them. And sometimes analysts are even afraid to issue a research that is not favorable because of some, possible declaratory practices that they might face from these companies. So some of the companies, might even limit you from accessing information to value them. Some of them might even take legal action, okay? And some of them can actually, so there are many things these companies can come into play to do. So because of that, sometimes analysts might even really not feel that free to issue, an adverse report for this kind of companies, okay? And it can actually make it difficult for them to conduct a comprehensive research needed to make an objective recommendation by the time they start, probably, limiting access to information and, taking some of these legal actions on the analyst. I hope we're together. I hope everyone can still hear me.
Yeah, I can see. Yeah, I can see and hear you.
Okay. All right. Then what about credit rating opinions, credit rating agency opinions? So we know that the analysts, so we have people we call credit rating analysts. I hope you people have done fixed income, credit rating under fixed income.
Can you say that again?
I said, I hope we have done credit rating under fixed income.
Yes.
Okay, yes, good. So we have the rating agencies like Moody, the Standard and Poor, what do they call the other one? The Fitch. And in Nigeria also here, we have many rating agencies, Augusta and Co. and other rating agencies. So we know what these rating agencies do. So rating agencies really look at some of these fixed income products and offered by companies, and they will rate it using any letter grade that they normally use, okay? So sometimes if you are an analyst, you work with a rating agency, sometimes you might also face some challenges in terms of independence and objectivity. So because of that, this standard also says that rating agencies should make sure that their processes and procedures prevent undue influence from their sponsoring companies. Okay, so if you're an analyst, you might actually face pressure related to your compensation tied to the rating. Okay, so if your compensation, whatever you are going to receive, is tied to the rating you are issuing or you are putting on the company, it can actually create a problem to your independence and objectivity, because the better the rating you give the company, the better the compensation you get. So there is high chances that this compensation structure might actually, create a conflict of interest for you. Okay. Another thing is that if your what do they call it? Your compensation is tied to the successful product placement, it can also create independence and objectivity clashes for you. Okay. So because of that, the recommendation is that members and candidates should actually abide by their agencies and the industrial standards of conduct regarding the analytical process and distribution of. So just summary, follow the industrial standards whenever you are operating in this scope. What about manager selections and procedure? Okay, please go on.
Yeah. Just, you might have probably said this in your first class, right? But then I just need to confirm. Does this particular standard also applicable for students, not just the holders, the certified holders only? Does it also apply to, okay, we are students? Do we have to comply with all of these?
Yes, all of them.
Okay.
Whether you're a candidate, so the standards and codes. So that's the Code of Ethics and Standards of Professional Conduct applies to charter holders and candidates.
Okay.
So if you're a candidate, yes. In fact, in some of the questions, by the time you start solving, you'll be seeing that there will be some of them they will use candidates. A CFA candidate is this. Some of them you see they're using charter holder. Okay, so it's candidate charter holder. That's what you'll be seeing. So it applies to you. So far as you have registered And like I said, before we end this, we are properly going to define who a charter holder is. So there are some qualifications or some things you need to meet up in order to be called a charter holder. Also, there are some characteristics or some things you also need to do to be called a candidate. Let me just talk about the one for a candidate. Like, a candidate is someone that has actually, registered in the CFA portal and actually paid for a particular exam. Okay, or someone that has just written an exam and waiting for their result. Let me give you an example. So if you have paid for the level 1, either May or August, you can be called a CFA level 1 candidate. If you, after writing your exam and you are still waiting for your results, you are still a CFA level 1 candidate. Okay, but now once your result comes out and you pass, but you haven't paid for level 2, that currently you are not a candidate till you pay. You become a CFA level 2 candidate. Okay. Anyway, so yes, we are still going to define some of those things and also define, even it happens for charter holders too. It happens to charter holders. So every year as a charter holder, you have to submit what they call annual professional conduct statements, right? And also pay for your fee. So if, like all the whole charter holders, sometime around May, your current subscription will expire. So you have to pay another one. So if you don't pay, you can't claim that you are not a charter holder till you pay. So if you can't pay, you can't claim that you're a charter holder. For you to be an active charter holder, you have to pay and submit that annual professional statement, right? So anyway, that is the last standard. So when we get there, we are still going to talk more about.
That's fine. Thank you. I just wanted to clarify that. Thanks.
All right. Okay. So members. So let's still talk about manager selection, procurement processes. So if you're a hiring manager or you are seeking investment allocation, okay, this standard says that so for the hiring managers, you are not to solicit any gifts. For if you are seeking investment allocation, you are not meant to offer gifts. Okay. In fact, this particular thing, I wanted to separate it before, but it's okay. So if you're a hiring manager, you are not to solicit any gifts. If you are seeking investment allocation, you are not to offer gifts, okay? That can compromise independence and objectivity. So basically, this is saying, if you're a hiring manager, don't compromise your independence and objectivity by soliciting gifts from the managers. If you are also seeking investment allocation from someone, don't go and offer that person gifts that can compromise their own independence. That is what the standard says. And this standard went ahead to say that that gift doesn't even necessarily have to benefit you personally to conflict with this standard. So if you tell the hiring managers that they should go and contribute to your favorite political party or charity organization, you are still going to be in violation of this standard. So that is actually what the standard says. Then on the terms of issuer paid research, I believe we know what issuer paid research is. Okay. So some companies can actually pay you to research their company. That's what we mean by issuer paid research. So imagine Dangote right now calling an analyst to come and research their company and also make reports. It's just like what they do in auditing. So a company calls an auditing company to come and audit them. So a company can actually pay a research analyst to come and research their company. That's issuer paid research. So if you are conducting an issuer paid research, you are to adhere to strict standards of conduct that govern the research process. That is actually what you are required to do. So you have to make sure that you conduct a thorough, independent, and unbiased analysis in this kind of research. Okay. So if there is any conflict of interest that is available during the research process, this standard says that you must, the key word is must, you must disclose them. Okay. Also, if there is any limiting compensation that can also influence your decision or conclusion, you must also disclose it. So anything that is going to make that research not independence or is going to affect the independence and objectivity of that standard, make sure you disclose it. Okay. Now, the best practice recommended by the curriculum is that whenever you are doing an issuer-paid research, make sure you only negotiate to receive a flat fee. So don't go and collect any fee that is based on your conclusion or your recommendation. Because if you are collecting any fee that is based on your conclusion or recommendation, it's going to affect your independence and objectivity. So because of that, the standard says that make sure you don't go and collect any payments that is based on the reports that you are going to go and issue. Or if you guys start collecting things like stock warrants or equity instruments, that so imagine now you are going to research a company and the company said that, okay, we are going to pay you with our shares, or we are going to pay you by giving you stock warrants. So obviously, if they are paying you giving stock warrants and you recommend the company to be bought, once people start buying it, those securities they give you automatically start increasing in value. So you are going to benefit. So because of that, there is high chances that you might be influenced to give the company a good rating, so that people can actually come and buy into the company. Since the company is paying you based on the security, you, the analyst, will also benefit from that kind of investment. So that's why they said the best thing is just negotiate a flat fee that is not linked to the conclusion you make or the recommendations that you make. Is there any question? I hope we're together.
Yes, I'm with you. On this, your point, I think, yeah, and even not just like for where I work at the moment, right? We also have a principle of making sure uh, our fee is not commission based.
Okay, yes.
Yeah, just to avoid this result, because if it is commission based, then definitely it's going to be based on end result. So yeah, it actually makes sense, because otherwise there's going to be a self-interest threat.
Yes.
When
Yes.
you're having things like that, there's definitely going to be self-interest threat, and which is not good for reputation, because at this point everything is about reputation. I mean, at this level,
Reputation.
as a professional,
Yes.
everything is about reputation. Yeah.
I'm
Yeah.
telling you, everything is about reputation. In fact, that's even what's holding the business, because once you start mixing or using that inappropriately, it can affect that reputation, which will in the end affect the business. Yes. That's a nice one. That's a nice. So you can actually relate to how this thing works in the real life. But I hope ethics as a course is actually an interesting course.
Yeah, it's always an interesting course for every profession. If
Yeah.
Because I've done one
Have you
before.
written ACCA? Have you written ACCA?
I wrote ICANN before.
Okay, I can.
And I also lectured
Okay.
ethics at some point in ICANN. So
Okay. No wonder. No wonder.
Detailed, and I think there are some parts of the course outlined here that is more theoretical than practical. But this is more, and because CFA has a whole lot of category, let's say category of segregation, like investment. You are also a broker. You are the one buying the investment. So there are a lot of places. So there are a lot of things to talk about here compared to what we do in ICANN. ICANN is just like a rush. Oh, kind of thing.
Yeah.
But then when you work in an accounting firm, it's easier for you to get all these ethics.
Yes. That's correct. Okay, that's great. So the final one we have under independence and objectivity is travel funding. Okay. So the best practice, if you are going to go and visit any firm, if you are researching any firm and you want to visit the firm you are researching, the CFA Institute says that the best practice is that you use commercial transportation at your expense or your firm's expense when you are going there, okay? Because sometimes some of those firms that you are researching, if they know you are researching them, they might actually offer to come and pick you up, offer to tell you, okay, so whenever you want to visit, you can fly, we can come and fly you in, we can send our corporate jet to come and pick you, okay? They can actually make you some offer. Okay, so in order to maintain your independence and objectivity, the CFA Institute says that the best thing for you as a member or a candidate is to travel to any of those companies at your expense or your firm's expense. But if there is no commercial transportation available to go there and the company is offering to come and pick you up, you might actually, follow and accept a moderately arranged travel from the company. Okay. Yes, that's actually what's recommended. I think by the time you start solving questions on this, I believe you will see some questions that pertain to this. Okay. Sometimes probably also, apart from even travel, the company might want to lodge you when you come there. Okay. So if also there is no what do they call it? Like any accommodation, very cheap accommodation that is closer to the company where you can afford to stay. And the company is offering to give you a modest accommodation too. You can also accept it. But regardless, if you can get an accommodation where you can also easily access the company, the best thing is to pay for your own accommodation and pay for your own flight. But if those two now becomes unavailable, okay, then you can actually accept what a moderate offer from the company. So all these things is just to say that don't go and accept things that would affect your independence and objectives. Like that example I was giving, someone was telling us a story about how they went to go and audit a company and the kind of treatment that the company gave them. This kind of treatment that after giving you, like you will not even just want to write anyhow report for the company. Okay. Can imagine a company you went to go and audit, probably they lodged you in a 5-star hotel with special dinner, special meal. They give you tickets to go and attend so events, go and attend this one, go and attend this one. In fact, they're just doing all things to make you happy and everything. So by the time you start looking at their financial reports, you are seeing many, what do they call it? Many funny fish shots numbers there. But because you have already started receiving things from them and they're even also offering to give you more by the end of the audit, they're offering to give you more. So by the time you start doing that, your independence and objectivity is already highly affected. Okay. So these are some of the what do they call them? Some of the standards that you need to meet up in order to be in compliance to this standard. Okay, so we have the recommended practices. So these are some of the recommended things that you are to do in order to be in what do they call it? In compliance. So you have to protect the integrity of your opinion. So if you're a member, you're a candidate, or your firm, you should actually establish policies for unbiased research reports on your corporate clients. Okay. Also, you should design a compensation system to maintain your independence and objectivity. So, like we said, there are some compensation systems that once you take, like the example you gave now, commission-based, you see that those kind of things can actually influence your independence and objectivity. Also, you can create a restricted list. Okay, so if there is any controversial company or any company that the company doesn't want to be given an adverse opinion, those kind of companies should be placed on a restricted list so that we don't even go ahead researching them in the first place. Okay, and if anyone we are going to research, we should only give factual information about them. Also, we can restrict special cost arrangements. So the example we just gave now. So the best thing is pay for your own commercial transportation, your hotel charges whenever you are attending issuers meeting. Okay. So like what we said, you have to limit the use of corporate aircraft, except when commercial transportation is unavailable, then you can accept this. Also, the best thing is to limit gifts. So we limit gifts. We can collect token gifts. So like I was giving the example, things like taking a coffee when you visit, that one is not a problem. If they give you a pen, if they give you a book to take notes. So if they give you some of these their company packages like key holders and some things that really are not tangible, you can actually collect those things. Those things wouldn't affect your independence and objectivity. But apart from that, any other gifts that you know that is really huge, that can impact your independence and objectivity. So you don't accept. So according to this standard, we can set a strict value limit for acceptable gifts based on local customs. Okay. Also, restricting investment. So we can have a formal policies on employees' purchase of equity or equity-related IPOs. And, we can have a kind of prior approval of any investment action in IPO. And sometimes the company can even impose a strict limit on the investment personnel acquiring securities in private placement. So those are some things that that we can have. Then reviewing procedures. So we can also implement effective supervisory and review procedures to make sure that personal investments are in compliance. Then we can also have our independence policies. So we can make sure we have a written policy on research independence and objectivity. So that's also another one. And the final one, we can also appoint officers. Okay, so we can appoint a compliance officer. And the job of this compliance officer is to make sure that the firm complies with the Code of Ethics and regulations. So these are some of the recommended practices by the curriculum that we can also do to make sure that we follow through with what the guidance says. Is there any question on independence and objectivity? Because we are done. So if you go to the curriculum, and if you go through the curriculum, you can see questions on independence and objectivity. So as we are done now, you can actually also go and solve it. Let me even check it. I think it has only 3 questions. Independence and objectivity has only 3 questions. Okay. So if you want to be sure that you understood all the stories that we have been telling here, you can go and attempt those questions and get them right. Okay. I hope we're together.
Yes, we are.
All right, good. So let's look at the third one. So we are still in standard 1. Remember, we said we have 7 standards. So I told us that this particular guidance is the longest reading we have for this. Okay. So the goal is that by our next meeting, we should be done with all this. By our next meeting, we should complete all the whole guidance so that we'll now know that we just have gifts remaining, and what do they call the other final one? Kind of examples. So there were some case studies that they brought in the curriculum to still discuss. Okay. But anyway, if you even follow through with all these things we are discussing, you can even go through all those case studies and see the whole thing by yourself. Okay. All right. So misrepresentation. This one is also another powerful one. So let's see what misrepresentation says. So misrepresentation says that members and candidates must not knowingly make any misrepresentation relating to investment analysis, recommendations, actions, or other professional activities. So you are not to knowingly make any misrepresentation relating to investment analysis, recommendations, actions, or other professional activities. So let's see what they define misrepresentation as. So according to the CFA Institute, they said that misrepresentation is any untrue statements, 1, any omission of fact, or any false or misleading statements. So this is what they categorize as misrepresentation. Okay, so you must not knowingly omit or misrepresent information or give false impression of a firm, organization, or a security. So this applies whether it's oral, written, electronic, or any other forms of communication. Okay. Now there is a particular one. I believe this is one of those ones that if you're not even careful, by the time you start solving questions, you see this one. Under this misrepresentation standard, you are prohibited from guaranteeing specific returns on any volatile investment. So an example of volatile investment is equity. So you are not to, so just for the sake that you are looking for a client, you notice that a member or a candidate told the clients that they can actually generate 10% return for them, okay, within certain period. This is a clear violation of this standard. Okay, so for any volatile investment at all, real estate, equity, and all those investments that their prices do change over, fluctuate over time, you are not to guarantee any specific return. Okay. So, but the standard noted that if there is any particular investment and that investment has a kind of built-in guarantee inside, then you can actually let the client know about that. But apart from that, once it's a volatile investment, guaranteeing any specific what do they call it? Any specific return is a clear violation of misrepresentation. Why? Because we know that because of the changes in the variables that affect the security, chances are you might not be able to generate that return you are guaranteeing. That's why it's a violation. Now, let's talk about the impact on investment practice. The impact on investment practice. Okay, so the standard says that members and candidates are not to misrepresent their qualification and credentials. Okay, so that means this will include things like maybe your CV. Okay, maybe your CV. So let's give a case study. A charter holder or an analyst saw a job vacancy, and that job vacancy is looking for 10 years experience in a particular role, and that person has only 2 or 3. The person now inflated the number. Okay, that will be misrepresentation. Okay, so you are not to misrepresent your qualifications and your credentials. You are not also allowed to misrepresent the qualifications of your firm and the services your firm can offer. Okay, also the performance record of your firm and the investment characteristics. According to this standard, you are not to misrepresent any of those things. Okay, now the standard went ahead to tell us that if you are going to use any third-party information, because there are sometimes we might need a third-party information when we are probably doing marketing or let's say doing testimonials or whatever. So if you are going to use any third-party information, that this standard says that you should actually exercise care and diligence whenever you are incorporating that information. Okay, just to make sure that the information is not misrepresented, because obviously if the information is misrepresented and I take that information without verifying it and just put it in my research, the whatever I put it in will also be misrepresented. Now, this standard also says that if you want to use external managers, we've talked about external managers under independence and objectivity. So let me give an example. So if in our firm, we do equity portfolio management, we also do fixed income, but we don't manage alternative investment portfolios, right? So because of that, if we have our clients that want to invest in alternative investments, we have outside managers that we're using for that. It's actually allowed, right? But if you are going to use it, this standard says that you have to disclose that intended use of external managers, okay? And you must not also represent the manager's investment practices as your own, okay? So if you want to be in compliance, these are the things that you have to do. So you have to disclose that, and you also have to not represent their investment practices as your own, okay? So that is what the standard tells us. What about performance reporting? What about performance reporting? So we know that over time, we have to report our portfolio performance to our clients, okay? We have to report our portfolio performance to our clients. And this standard, according to this standard, you mustn't add a benchmark when you are reporting, okay? You mustn't add a benchmark when you are reporting, okay? Because we know that there are certain kinds of strategies that we might not have a suitable benchmark to report. So this standard doesn't require that you always have to provide a benchmark. But if you are going to provide a benchmark, according to this standard, then you must make sure that that benchmark is transparent, one, and also that the benchmark you are using is comparable to actually what you are doing. So it's not like you are managing large cap equities, but the benchmark you are using is small cap equities. It has to be comparable. So if you are managing large cap equities, you need to look for a benchmark that also uses large cap equity strategy. Okay, So it has to be comparable. Yeah, it has to be comparable. Remember, like we said, it's not must that you have to report a benchmark in order to, to comply with this standard. Okay. So the standard says that if we are going to use a benchmark, we have to disclose the reason behind using this reference. So it's more like to help us know that this benchmark you are choosing, are you choosing it because it's the right benchmark, or are you just choosing it to tell us that you are doing well? So probably a particular investment manager didn't perform so well. He will go and shop for a benchmark, look for a benchmark that he outperformed. Okay, you might go and look for a benchmark he outperformed and report it as a comparable benchmark so that you can now see, oh, okay, at least he outperformed this chosen benchmark. That means he knows what he's doing. But by the time we analyze and look for more appropriate benchmark, we can actually even see that the appropriate benchmarks that he must have reported or he could have reported are actually doing better than what he did. So that is why the standard says that you have to disclose the reason behind the benchmark you decide to use. Okay. Then also, if you're a member or you're